Welcome to Conveyancing Matters with Lorraine and Stu. Join us for a chat about all things property.
Hello, Mr. Forsdyke. How are you?
Hello, Mrs. Richardson. I'm very well. How are you?
Yeah, I'm good, thanks, lovely. So, this Conveyancing Matters, we decided, didn't we, that we were going to go straight into a big topic for everybody and talk a bit about mortgages, which, to be fair, we kind of touch on a lot in our Conveyancing Matters chats, don't we? Because obviously the lenders are a very big client and a very big spectre in relation to what conveyancers do every day. But one of the things that caught my eye fairly recently, Stu, that I thought we would probably have a view on, is there is a lender out there, a sort of, I might say, not a mainstream lender that everybody would necessarily have heard of, but that's thinking about offering mortgages to at 7 times the applicant's salary. So instead of the usual 4.5 times your salary is what you can borrow, there's a lender out there, Stu, that's thinking of relaxing that requirement to 7 times the salary. So what do you think, Stu? What's your view?
Well, we kind of sort of said a bit off air, didn't we, that it's sort of leaning back to those days when we had 110% mortgages, 120 even, and the mess that we got into in 2007 and 2008. Are we going back that way? And do we need to have a relaxing on lending rules? I never quite get my head around the sort of the risk analysis that the lenders talk about when lending and the security that they want, and then we hear something like that, which I find a bit hypocritical, maybe.
Yeah, I do. And I think, well, actually, for someone as old as me, Stu, and I realise you would have been in, shorts probably, wouldn't you, when I qualified? But I was made redundant 6 months after I qualified in 1991 because there was a big property crash. And friends of mine at the time who had houses, who at the time were first-time buyers, they were stuck in negative equity situations for a long time, which, for those who don't know, is somebody that owns a house that's worth essentially less than the mortgage, the outstanding mortgage on it, couldn't sell, were really trapped. And this is, and people forget that mortgage interest rates have been as high as sort of 15%.
Yeah.
And I just worry that everybody's memory is very, very short. And clearly there are a lot sort of cleverer people out there than us, Stu, in terms of sort of mortgage matters, but it's often the conveyancers that are at the sharp end, really, isn't it? And I think what's interesting about this is that you and I on Conveyancing Matters can have an opinion about this, but of course the acceptability or otherwise of a mortgage product isn't, as you'll no doubt tell everyone, something that we can actually advise on.
No, you're 100% right. And we could just sort of strip the whole thing back and say, well, we shouldn't be giving any opinions on anything to do with financial matters or any product that any bank ever offers, because it's absolutely nought to do with us. And to give financial advice is obviously well outside of our remit. But of course, we go on about this a lot, don't we? But even though that is strictly the case, the waters are always a bit murky, aren't they? We still give a mortgage report. And of course, are our mortgage reports, strictly speaking, legal related? Do we tell our clients what they're repaying monthly and how much they're borrowing? Well, of course we do. So there is an element of those lines, merging, isn't there, at times? I just can't sort of comprehend in this market why we need to relax any kind of lending criteria.
No, I can't at all, Stu. And yeah, you're right. I mean, the extent to which conveyancers, really perhaps should be giving any comment on mortgage offers is really, to explain the consequence, of course, if the borrower doesn't keep up their repayments, which of course is, ultimately repossession. But sort of almost by definition, you can't really talk about that, as you've just said, out of context, because you've got to say, well, this is the purchase price, and we've got to say, and that's got to be the same in the mortgage offers in the contracts. That's very relevant to us. And, section whatever it is of your offer says, these are your monthly repayments. This is what fixed rate means. This is what a repayment mortgage means. And as you say, you sort of get sucked into it. So you have to have a bit of context. And of course, you can't then talk about the possibility of being repossessed without mentioning potential early redemption penalties, which are also specified in the offer. So as you say, we do you're right, we do get sucked in, really, I think.
Yeah, and it's always, if you take early repayment fees as an example, and what a client may look to get themselves into. I can't think of any recent examples where I've seen this, but of course you could have a client that is looking to, buy, maybe sell within a couple of years, that kind of thing, which may mean they then incur that cost. Do you how much due diligence do you do with your client, linking them to that mortgage product that they're taking? But again, we're just, in my opinion, going so far outside our remit that, where do you draw the line if you're going to start looking into bits like this?
Well, I think the problem also is, and this is something we say a lot on Conveyancing Matters, don't we, Stu, that yet again, because we're the sort of properly insured part of the deal and the transaction, if something goes wrong, and the first person the client's going to complain to and try and get any losses from is the conveyancer if something happens to go wrong. So I certainly do think that we need to be sort of pointing out and saying section 1 of the offer says this, section 2 points out this, section 3 or whatever it is, section 10 or 8 or whatever it is, contains the early redemption penalties, and explain at least what that means. But this idea that we can't give, and of course quite rightly shouldn't be giving financial advice, is absolutely bang on. But
don't forget the other question, and is the other client, of course. We so often gloss over, don't we, that actually you've got two clients in question here. You've got the bank that say one thing, you've got a client that says another. And, I do often wonder, and I know this is not a new subject, but the way or the expectation of a client now, and our remit in acting in their best interests, and also the bank's best interest, is there a conflict? Is separate representation for the client and the bank something that may happen in the future? Is it plausible that we can do both?
Shall I tell you why it won't be? Because nobody's going to want to pay. Yes. Nobody's going to want to incur 2 lots of legal fees. So it won't happen. It absolutely won't happen. You're just going to have firms that push down fees and are happy to take on the liability for both, quite frankly. And of course the irony is, and again, as I'm sure we've mentioned before, that of course the lenders, in the event that there's a downturn in the market and the lender sells at a loss, the first thing many lenders are going to do is aggressively come back to the firm to try and crawl all over that file to see if some incorrect advice or a handbook requirement hasn't been met. The lenders are going to have no hesitation in having a pop at your insurance.
Of course not. But where do we stand then with, I don't know, we're acting for a client, we're acting in their best interests, and the matters exchanged contracts a week before completion, our client gets made redundant and they let us know. A material change to their circumstances, our obligation under the retainer with our client, the lender, is of course to let them know. But how is that acting in our other clients' best interests?
Yeah, and I think that's,
by the letter of the law, it kind of works.
I think that's the inherent conflict, isn't it? But I think that's probably what, and again, a lot of firms, probably need to look quite carefully at their terms and conditions here, and also the sort of standard information that they give their buyer-borrower clients, because that's exactly the sort of thing that a buyer-borrower needs to understand, that they should be that's got to be reported to the lender if the conveyancer becomes aware of it, that overriding duty to report a material change. And of course, as we know, if the buyer-borrower says, no, I don't consent to you giving the lender that information, well, all we can do is decline the offer and decline to complete. But I think the buyer-borrower client has got to understand that, and this is something that concerns me. Do
you think they do, though? As a generalization, I'm sure all law firms point out that we're acting on behalf of the bank, blah blah blah, but do clients really understand or believe that in its true sense of the word? I'm not sure they do.
Well, I agree with you. I mean, there was some fairly recent SRA research where lots of people said, well, we didn't understand what leasehold meant, and we had no clue what it was all about. And I have absolutely no doubt that conveyancing firms sent reports to the clients, which of course the clients don't then read. Lots of people don't read them, but there is, that sort of central fundamental potential conflict, I think, between the buyer borrower and the lender clients is, I think, sufficiently important that we need to be highlighting it, perhaps reminding the client, maybe, you know, it appearing 2 or 3 times in different ways, because I do think that's so fundamental, the point you've just made. Well, the offer can be withdrawn. There's no obligation on the lender, and an obligation on us to report. And one of the things that concerns me a bit, Stu, is that I think a lot of people just report something, whatever, to a lender without getting the consent of their buyer borrower to do that, possibly without even understanding the conduct need to do it, the fact that we've got a duty of confidentiality to the buyer borrower, and if they say, I don't want you to report that dodgy Enviro search result, well, strictly we can't. Now, you and I know all we can do is send the offer back without comment, but I
do feel sorry for conveyancers in these circumstances, though, because we're drilled, aren't we, on report, if in doubt, report it, if in doubt, report it. We're drilled on reporting to the extent now that, you know, I think previously the worry was not reporting something that was material. Now I think people just take a risk sort of a risk approach that will report any. If I'm not sure, to report.
Oh, I agree. And
I've seen some things being reported, and I'm like, what on earth are you telling me?
You know damn well the lender's going to come back and say, well, we're not commenting. We rely on you to protect our security.
Professional opinion. Yeah,
that's what they're going to say. And actually, to be fair to the lenders, in many cases, they're going to be right. But I do think firms now should have almost a standard email or some standard guff that says to the client, we have to report this. And if we report, you know, we are under a duty to report X, whatever we found out on your file, to the lender. And please note the following consequences could be: 1, there's going to be a delay. 2, we can't go ahead till the lender tells us we can. 3, the lender might change the terms of your offer. 4, a worst case scenario, the lender might withdraw the offer. You know, please confirm, please acknowledge receipt of this email to confirm you understand. And you get that back before you report to the lender. You know, and that concerns me quite a lot, really. But again, coming back to this, the issue that's sort of very much in the remit of the mortgage broker and not the solicitor. But again, the sort of short memory things too, because allied to the 7 times salary thing, I also noticed, reported tail end of 2021, that the Bank of England is consulting, and I quote, on withdrawing its affordability test recommendation, which says borrowers should be able to afford their mortgage if their mortgage interest rate is 3% higher than the reversion rate. So the Financial Policy Committee is effectively consulting on withdrawing that safeguard that was introduced as a direct result of the mortgage market review that followed the 08 crash that you've already mentioned. You know, the idea that borrowers have to, you know, they have to essentially do additional sums to make sure that if, as I say, if interest rates go up by 3%, the borrower can still afford it. And again, what bothers me about that is that on the one hand, as we've just said, conveyancers, solicitors, licensed conveyancers can't and shouldn't be advising on that specifically, but it is going to come back and bite us in the backside if a client takes out a mortgage product with far fewer safeguards at the point the offer is applied for, and if they get repossessed and you know, and there's a negative equity situation, they're gonna come back and look at us again. They're going to look at it's
a real strange one, isn't it? I can't get my head around. You're about to lend somebody money and you're going to reduce the volume of information that you look at to test whether they can afford it in the first place. Makes kind of no logical sense, does it?
Well, they apparently said that the making the rules simpler, it's only a consultation allegedly, so the mortgage market recommendations introduced in 2014, so they've not been around that long, strengthened affordability assessments, and here we go, to prevent consumers from taking on unaffordable mortgages, which surely must be a good thing. But now they've said that essentially this hasn't really made much difference to what mortgages people take out, and you know, we don't really think it's necessary, and it's the problem is first-time buyers coming into the market. it's stopping first-time buyers potentially coming into the market. That's their view, but I simply don't understand how that can be responsible. So I suppose if there's any mortgage brokers out there that want to that want to comment on the consultation when it's issued, then they should be, really. But I worry about this stuff, Stu, because we can't recommend a particular lender, we can't comment on whether a deal is a good deal, but how many clients, Stu, over the years want our opinion?
Oh,
it's what clients want all the time, isn't it?
Of course they do. But they want you to say that you think, yeah, they're doing the right thing. But where do we go with it? Like you said before, it's so different now, and people expect much more of a moving service than necessarily a conveyancing one. But it does worry me. I can't understand why the banks would look to reduce the criteria. That doesn't make any sense to me whatsoever. And like you've said time and time again, you're just increasing the chance of something going wrong. You're increasing the chance of somebody not being able to afford it. Therefore, the banks have to take possession of the property, and therefore, they're only looking one way. Like we've said 101 times about who's the one insured and blah 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 blah. You would have thought the basis of what they do. If I'm going to lend somebody some money, probably one of the first things I do is check whether they can afford it. I can't. The analogy doesn't work for me.
No, I must admit I don't follow the logic. To be fair, if somebody wants to come on and explain it to us, I would be genuinely interested to listen. But the irony is that one of the things that's being quoted here is that, quote, soaring house prices over the last 10 years are sort of excluding first-time buyers. But I think, and it's again no more than a sort of non-stats based personal opinion, that we're not going into another year or two of very, very high, strong market. If anything, the market's going to be tailing off a little bit in the next few years, where it's not going to, the cost of living at the end of this year, the end of 2022, all of the things, the national insurance hike, fuel, all of that, that's all going to kick in. If the economy doesn't get as strong as we expect it to be, people's jobs are going to be at risk. We're not going into a period of what looks like further sustained price rises, are we?
That's right, without a shadow of a doubt. Yeah, there'd be no reason why that might be the case. I can see it stabilising, but yeah, you're right. I mean, how much longer could it go on increasing at the rate it was? Probably not. I mean, whilst the demand is there, obviously prices will remain high. But I think, when we talk about prices and negative equity and recessions, it's such an eye-opener, isn't it? And when I went into that period of my professional career, I had absolutely no idea the extent that, the proverbial was about to hit the fan and what it actually meant practically. People physically couldn't get mortgages. They didn't have jobs, so there wasn't affordability. They just couldn't get one. And there's not work out there you can go and get. It's just not there. Nobody moves. And, you don't really want to sort of, entice anything like those situations again, especially with what we've been through over the last few years, and I don't know, would you use the right word in fragile state of the economy? Maybe it's not fragile at the minute, I don't know, but like you say, it's a risk with everything that could come, isn't it? We could easily be looking at a market crash within the next 5 years, I would suggest. Whether it be imminently, probably not, but certainly within a period of time, you'd suspect that there will be some kind of dip.
Yeah, and as I say, if you get the sort of relaxing of loan to values, income affordability, and income multipliers and affordability, that to me, and diminishing prices and interest rates going up, none of that sounds like a happy mix, really. But I think
I can remember the last recession, and coming into the office, and all I was fielding were calls, emails saying that I'm pulling out. And we had numerous people that would walk away and default on completion because the value of the property was going to be so, less than what they'd agreed. And losing the deposit wasn't any type of consideration to them because the market was crashing.
Yes, it was that became very much then the lesser of two evils.
Two evils, yeah. So why on earth we'd think of that? And it's a bit like anything, isn't it? When certain things are the way they are, the worst thing you do is start changing things. You don't know what's going to come in the next few years. So let's not lessen affordability criteria on mortgages, surely.
Yeah, I would have thought so. I mean, I'll be genuinely interested as and when this consultation gets out there. We had lovely Nikki, didn't we? A lovely mortgage broker on, to get a mortgage broker back on, perhaps, or indeed somebody from a bank to sort of, to talk to us about that side of the fence. So that might be, I think, an interesting one. But hopefully, Stu, in this chat, we've highlighted and reminded some of the responsibilities of conveyancers as well. And as ever, the risks, really, a mortgage offer can be withdrawn. And I think
the biggest one, isn't it? The key thing is always to we must always remember to inform our client that, we make a contract between a buyer and a seller. We don't make a contract until completion and we use the money between the buyer and the mortgage company. They're not interlinked. So many people think that they are. But yeah, the mortgage company can withdraw anytime. I actually had a client, I think it was one of my first ever clients. So when I was a real early doors, wet behind the ears, definitely within the first few completions I'd ever done, and I had a young couple client, and I was using my previous firm's sort of standardized reports and stuff, so the clients are fully briefed, but they went out and spent fortunes on buy now, pay later type deals for furniture in between exchange and completion. Both of their credit ratings plummeted, and the bank pulled the offer.
And again, it's the
simple as that.
It is. Well, and it's this
Material
again.
change.
We've definitely mentioned this before, but the idea that reminding conveyancers that if you're aware that your client has gone out and spanked X pounds on a credit card, as you've just said, or they're going to pay off other borrowing as part of condition of the offer with other borrowing, they're all things that directly impact on affordability and are a material change which needs reporting to the lender. I mean, I've had clients just be absolutely, aggressive and hideous, because one chap told me his missus was, about to, he told me that they hadn't declared it at the time they made the offer. She was about to go on maternity leave for, I don't know, about a year or something. And I said, well, you're going to have to put that to the lender via the mortgage broker, and if they don't, and I don't get an acknowledgement that that's been done, I'll have to do it. And he was so abusive. It's
difficult, isn't it? Because you can understand a client's frustration. But again, it's one of those. I'm not sure what's. I'm just trying to think. Every time I've applied for a mortgage, whether it be direct or whether it be via a broker, is it really ever made clear that that's the case, that we as lawyers have to do that? We as lawyers have to verify everything that's been said. The amount of times we get grief from gifted deposits that crop up and that have been declared supposedly, when clearly they haven't been properly declared, if you want to call it that, and all that side of it. It's a difficult one, isn't it? There's definitely a disjoint, isn't there, between what we do, the banks, the clients, the fact we have to act on behalf of the bank. It's not a seamless transition, is it?
No. Well, on that slightly depressing, miserable note, Stu, that's probably...
Sorry, I didn't want to down the mood.
Well, it wasn't that exciting to start with, but...
that's as exciting as we can make mortgages in conveyancing, isn't it?
Well, it is, but it's important for our clients and it's important for us, and the lenders are looking to move the goalposts a bit, and I think conveyancers need to be aware of what's coming up, really.
Yeah, I think we as an industry, we've probably never been under as much pressure from the lenders as we ever have been before, and that is on a number of different things, isn't it? Number of different parts. So whether it be registrations, whether it be ensuring priorities are in place, reporting stuff to them, making sure your files are properly in place, and so on and so forth, not reliant on anything the lenders may have done. We have to cover everything off. I don't think that pressure's ever been as high as it is now, and that's why I do have that empathy with conveyancers with large caseloads. Insofar as they're under that continued pressure, not just from everybody to get the deal through, that, you know, you've still got that person in the background that you have to play a vital role with. They're still your client. There's still a lot of compliance that goes into it. And of course, you're not going to be Mr. Popular with everybody else when you're going through that. And of course, the fact that you can't always explain some of the things that you might have to be doing with banks and clients and everything else to other people that may be chasing for updates. So,
well, exactly.
It's not a nice position to be in sometimes, is it?
Not really, Stu. Well, on that bombshell, we'll end this Conveyancing Matters. So, well, thanks for that, Stu. And hopefully that's given our conveyancer colleagues something to think about, something else to think about. And we'll no doubt see each other soon.
Yeah. Take care, Lorraine. I'll speak to you soon.
Bye.